Hey, what's going on everyone? This is Blue Vein with Profiteer Trading, and today we are going to be doing a video on what are futures, just a very, very bare bones minimum. This is what they are, this is how they operate, and this is how you would start to get involved with interacting with the futures markets. So going straight into what is a futures market, basically they are contracts that have underlying assets. So what you're looking at right now are the contract specifications for crude oil. Essentially, how this works is crude oil has its own market on the New York Mercantile Exchange. So it's the crude oil futures market. And this market allows for people to then buy and sell and exchange and facilitate trade with these crude oil contracts. So if you want to buy oil, if you're a gas station or someone who needs this light sweet crude oil, then you can go and buy them using this exchange. So why is this important? Why is this something that's good for the overall stability of the economy? Well, because supply and demand is always shifting. And it's very important for businesses like a gas company to be able to have those costs pre-calculated. So if we look at this contract for crude oil, we can see one contract is 1,000 barrels of oil. And your minimum fluctuation is going to be 0.01, and that is representing $10. So how do you process this? All that means is that if you buy one contract of crude oil, you are saying, I want 1,000 barrels of oil. That fluctuation, the minimum fluctuation is point, so it's just like anything else, just 1 cent. So the most, or the smallest amount increment that it can change is 1 cent. If it does change 1 cent, that's an unrealized profit loss of $10. So if I buy at $50 and sell at $50.01, I would make $10. The product symbol is just CL. It's going to change based off of your data feed, but we'll get back into that. These are just your trading hours and contract months all. So that means there's a new contract for each month. Every single month, a new contract will come out, and that contract has an expiration date. So at the end of the month, it'll expire. What does that mean? Well, that means if you're a gas company and you need 1,000 barrels of oil in 2 or 3 months, you're going to go to the contract that's 2 or 3 months out, and you're going to buy oil on that contract. That way, when it expires at the end of that month, you're going to then have the right to buy or to get 1,000 barrels of oil at that agreed upon price. So all it is these buyers and sellers coming together saying, hey, at the end of this month, I'm willing to then sell you 1,000 barrels of oil at the price agreed upon in the contract. So that's essentially the whole purpose of them. It works for a lot of commodities. You have corn, grains, metals, all of that. And it's just a way for businesses to have these contractual agreements of what the price is going to be a few months from now. That way they can have it in their balance sheet. Now, how do we take advantage of that as intraday traders? Well, we're not trying to buy 1,000 barrels of oil. We're just trying to make money on the crude oil market. So that's what that is called, is a settlement. So at the end of each month, there's a settlement. And with crude oil, it would be a physical settlement, meaning, in theory, if you bought a crude oil contract and it expired, you would have your someone contacting you to then come and finish the transaction, and you'd be looking to buy or to get those 1,000 barrels of oil with the agreed upon price. Most of your retail brokerages are going to flatten or cancel a physically settled position before it has the time to expire. So that's something that you have to look at when you're considering what kind of a brokerage to use. Or you just make sure you're not holding these contracts for a long time. If you plan on swing trading crude oil, then that's something you have to be attentive to. But if not, then you will be okay. So going back into what this all means, we'll look at one more contract. So this is the E-mini S&P 500. This is a financially settled contract, meaning this is every quarter, so there's only for a year. But if this expires, all it's going to do is just flatten your transaction, so it's just going to close it out. There is no physical settlement because it's just representing the underlying asset is not anything physical. It's just $50 times the price of the S&P 500 index. Your minimum fluctuation is 25 index points, so that's basically 25 cents if you want to think about it like that. You can't buy a contract here for $3,000.10. It would be $3,000 even, or $3,000.25, $3,000.50. 1 point in the E-mini S&P 500 or ES is going to be $1, and one tick is going to be 12.50. So if the E-mini S&P 500 moves $1, that's 4 ticks, 4 of these fluctuation points, 4 quarters. If you want $1, you're going to have 4 quarters as a U.S. currency equivalency. So that would be a $50 unrealized profit loss. Different trading hours because it's a different product. And that's essentially what we're talking about. So we're not buying a share, we're not buying anything. It's a contract. It has an underlying value, and that's how it's leveraged. So if you buy one contract of the E-mini S&P 500 and it goes up 2 points, that's $100, right? If you buy 2 contracts, then that would be $200. So even though the price only went up $2 or 2 points or $2, that still has a leveraged P&L in the underlying asset. So you're not borrowing money. You're not taking out margin saying, here's my day trading buying power. I'm going to buy extra shares. That's not how it works. It's just these contracts inherently have that underlying value to them, which make them leveraged. So another concept that you might not be familiar with that you're going to have to get used to is the different exchanges. With futures, these are your primary ones right here. So Chicago Mercantile Exchange, that's going to have your equity indices like that E-mini S&P 500 currencies meets softs. CBOT is going to have financials, grains. NYMEX, which is your New York Mercantile Exchange, that has your energies. So crude oil was the first contract we looked at. That's on the NYMEX. And COMEX, metals, so gold, silver, things like that. Typically, when you get your data feed, it's going to have most of these. You should be able to pick which ones, or if you pick all CME products, it should have all of these in there. And just what you need to understand about them is that since you're interacting with different exchanges, each exchange has their own hours, and they all have their own pit session opens. So that's when you're going to get the most liquidity. You're going to have increased volatility during the open, etc. So, like for example, NYMEX. Crude oil pit session open is at 9 a.m. Eastern. So that's a timeline you want to be paying attention to. Your core components of futures trading, if you're just someone who has been using Robinhood or Thinkorswim or whatever it is, wherever you are, if you're interested in trading futures, you need to have these 3 things at a minimum. You need to have a broker or a clearing firm, or someone's got to hold your money and be managing your account, etc. You need to have a data feed, so something like CQG or Rhythmic, and all this is it's giving you that tick by tick, time and sales, quality, real-time data connection to the market, as well as routing your orders to the market itself. So when you place an order on your platform, they're the ones who are sending that order in to get it filled. Charting and execution platform. Obviously, you need to have a place where you can hit the buy button, hit the sell button, looking at charts, etc. So this is a very nice thing because it makes it very flexible. You can really kind of have a modular way to pick your best options. You're not stuck with anyone because if you don't like, say you've got a broker and you have that broker, you like that broker, but you don't like the data connection that they were giving you. Well, with futures, you have a lot of different options. So you can go with CQG, you can go with a Rhythmic, you can go with a Data IQ connection, and you can really kind of create your own solution based off of what works best for you. Same with charting platforms. There's a lot of really nice, solid charting platforms out there that can do a whole lot of advanced things that you probably haven't experienced if you're just someone coming in from a Thinkorswim or a Robinhood or a Webull. Key factors to understand when you're looking at all of this: what are your software and your data monthly fees? Are there inactivity fees with your broker? What are the commissions they're taking? What are the understanding the CME exchange fees, the CQG routing fees? Looking at how this all comes together. You might be thinking, oh, everyone's got commission free now. What are these guys doing? It's worth the cost. The fees aren't all that much. It may look like it, but they're not. you're looking at like $1.80 for an E-mini S&P 500 contract, $1.80 or so per turn. So, $3 and some change for that round trip on that trade. It's worth the cost. Having that solid data connection, quality execution, fast fills is worth every penny. Because guess what? All of these guys that are going commission free are going to have to make it up somewhere else. So they're going to start routing your orders through other systems and it'll get delayed and lagged. Quality is going to decrease as a means to cut costs. So again, this is not supposed to teach you how to trade. This is not anything like that. This was strictly to show you the core components and try and visualize and understand what futures are and what you might need to interact with that marketplace. If you are interested in actually trading these products, that's a whole nother story. I have a video on why you should trade futures. We have that uploaded, and there's also a beginning and introduction to day trading, where it's probably the only video you'll see that's an intro to day trading that doesn't show a chart, because you really shouldn't be hitting the buy or the sell button for at least the first few months when you first interact with trading. That's a whole other topic. You can go to our channel and see those. There's a lot of quality content and a lot of bad content out there. Be careful. Capital preservation is the name of the game. Don't be one of the 90% that lose 90% of their capital in 90 days. Give yourself time to learn this craft. All right, I hope you enjoyed. I hope you learned something. Check out other videos. Go and learn something new every day about trading. And I will see you all in the next one.